Welcome back, everybody. On today's show, we're talking about our annual outlook, which may surprise some of you. So, Matt, kick this off right. What's our price target for 2026?
Yeah, we don't have one, Steven, and I could give you a number because I have an earnings estimate and a multiple I could throw out there and say here it is, but I think this annual outlook exercise is more so just a great opportunity to focus on the things that matter and the stuff that we do that has more value than that.
Gotcha. Okay. Well, then what are we focusing on, or what should we focus on, or what else is going on here?
Yeah, I think in all seriousness, and I know the folks that do have price targets have lots of other analysis and research that helps their clients, but in the same way, rather than thinking about a number that has a short-term time horizon, we think about a few things. Number one, we're not at all trying to be cute or tactical with any of our trades. We don't pick themes or sectors or rotate. We are diversified index guys that buy and hold. And I think one of the most compelling data points I've seen is a JP Morgan stat from last year that showed the cumulative returns if you own the S&P for the 20 years ending in 2024, you made 10% per year, which is consistent with the long-term average. But if you missed the 10 days that were the best days in those 20 years, so you're talking about a very small fraction of all the days, your returns got cut in half. So from a timing perspective, we think just owning and owning and owning over time is going to do better than trying to be cute and dance around when you think the market's cheap and buy more and sell more when you think it's expensive, which leads me to my next point of rebalancing. And that's something that research has shown is at least a neutral to performance depending on how you study it and how you do it. And even if it has no impact quantifiably, the emotional impact I think is huge because human nature would have us buying more when things are going up and selling more when things are going down. And
Sure.
The rebalancing system you've implemented that we've done here at Birchwood for a long time is the target bands where, hey, if your stocks go up a certain amount, we're selling those and we're buying more bonds to take chips off the table. And vice versa, when people are scared and panicking and the market's going down, we're selling bonds and we're buying stocks to leg into that weakness. So even if it has no performance impact, although I do think it's positive over time, the emotional benefit I think is really big.
Yeah, so I think the big key here is having a system over a emotional response, maybe is the way to summarize it.
Yeah, especially because our emotions are our biggest enemy when it comes to successful investing performance over time.
Yeah.
And we think that's best for us and best for our clients.
Yeah, and I think jumping back to the data that you mentioned just previously of if you miss out on those 10 best days, and I think those 10 best days occur when the market is going crazy and things are looking pretty bad. So I think that's the hard thing during those instances is to stay strong. But I mean, like you said, if you miss out those days, then what was it? Half of your portfolio or the return of your portfolio.
The 10% annualized return over that 20-year period drops to 6. So if you invested $10,000 at the beginning of the period, you ended with 70 if you just owned it the whole time. And if you missed those 10 days, you only had like 35. So you effectively get cut in half in terms of your long-term returns, which is really painful if you think about it. And so we just think owning and buying more when things go down through rebalancing is a better strategy than trying to time things and maybe stuff that would be more complex than that.
Yep. All right. So most folks have a lot of questions and concerns about valuations and being in a bubble or the impending crash that's going to happen, Matt. It's going to happen. We've been flipping heads, all the time. Tails is going to come up. What do we do? When is it going to happen, Matt? What's the deal here?
Yeah, I think there's a lot of reasons. There's a lot of parallels that people can point to that are similar at face value to 2000, where the tech sector had done well for a long time. Multiples had expanded, at least for certain companies, and lots of companies were raising capital with no revenues yet. So there's a lot of things that people can point to say, aha, this is it. It's happening again. But there's also lots of things I think that make the other argument, which is the valuations of some of the biggest companies are still very reasonable. There's actual revenues being generated by AI, at least for certain companies that are raising capital at big valuations. And I could keep going, but there's lots of reasons to say it's not a bubble. But either way, with our philosophy on owning diversified indexes, both U.S. and international, by spreading out your chips, if a certain company or a certain sector does badly, yeah, that might hurt for some period of time. But one of the funniest charts I saw recently was the best performing stocks in the U.S. since 1995, so pretty long time. Guess what number one was, Steven? Who was it?
I don't know. I'd say like Amazon, Apple.
Monster Beverage.
Okay.
So that one cracked me up because you could have given me 100 guesses and I would not have guessed it was a company that sells energy drinks. But I think that just makes the point of, hey, by owning a broad index that has hundreds and thousands of companies in it, you're going to have some winners that you didn't expect. And over time, some of those winners can be material. And our philosophy is that we're better off just staying diversified and keeping things simple and owning what will eventually be the long-term winners, even if some of the companies that have been big winners in recent years struggle and have issues that hurt the index for a short period of time. Eventually, other companies will step up and carry the torch, as has happened for decades at this point. So AI, we'll see. It remains to be seen. There's arguments for either side, but regardless, I don't think it's worth changing anything with regards to how we invest and how we think about the market over the very long term, which is what we think is more important.
Yeah, and I think a lot of people get caught up in the feeling that, Matt, Steven, why don't you just pick those companies that are going to be winners? Then that doesn't seem that hard to do. Why don't you just get those guys and own those guys? Unfortunately, we only know that those things are winners looking in hindsight and looking back into the past and going, oh yeah, that company did really well, but we only know that after the fact. We don't know that forward looking. We have no idea. We have no idea what company's going to, be the next big thing.
And I think to that point, Stephen, one of the most underrated pieces of research that comes out twice a year, every year, is the S&P study that shows percentage of fund managers. I think it's just mutual funds, but regardless, out of hundreds of firms with lots of resources and really smart people trying to do exactly what you're just describing, of pick winners and losers and own more of the winners and less of the losers so that you can beat the market, a very small fraction of those people are able to do that successfully over very long horizons, which again just gives us confidence, at least it gives me confidence, and I know you, Stephen, in our approach of, hey, if we can guarantee we're in the top quartile or even top decile of professional money managers by keeping things simple and owning the index, then that seems like a winning strategy to me.
Yeah, you can list those top performers, on one or two hands. It's not that many, right. And to kind of think that, anyone can do this is it's a pretty rare ability. And even if you could invest with those folks, you're probably not getting in the door unless you buy Berkshire Hathaway. And even Warren Buffett, hasn't been on a great run for the last 25 years, and he's retiring because eventually you run out because he's getting old.
Yeah, the grind wears you down. He's obviously done for a very long time, but to your point, there's been some challenges there recently that are worth paying attention to. But yeah, to your point, the number of people that have outperformed over long periods of time is very, very few, and we think our clients and ourselves, what we do with our own money, we're better off keeping things simple and staying diversified with indexes.
All right. Well, Matt, can you at least give me the super secret strategies? I know they're out there, that all the experts know, that get hidden from the general public. What are those secret strategies?
Yeah,
Come on, man.
I've been excited to dive into this one for a while because I've been doing a lot of research and doing a lot of digging to help build confidence. And Stephen, I'll talk through them here in a sec. When I know you have a visual you're going to pull up, and then we can dive into more detail.
Yeah, you've been working pretty hard at this one, so I want to give it the time and attention that it deserves. So yeah, you put this together. Here, I'm just going to share my screen here of kind of the market outlook here. So yeah, 2026 market outlook. Here's our comprehensive guide to this next year that the experts keep concealed from the general public. So yeah, pretty extensive study here that we got going on in. Oh, shoot, man. Okay.
Yeah, there is no comprehensive guide because nobody knows what's going to happen. And there's lots of data that shows predicting anything, but including the markets, fundamentals, the economy over any period as short as a year is a fruitless exercise. And so just back to your initial question of, hey, what do we think for the next 3, 6, 9, 12 months? The answer is, I might have a view, but I don't think it's worth doing anything different than what we're already doing, which is customizing asset allocations based on the client situation and sticking with that allocation through thick and thin with rebalancing. So predicting the short term is a really hard game, and there's very, very few people that do that well. And the ones that do, are not taking new money. So
Yep.
we're left to what we think is the winning strategy based on the cards that we have.
And it doesn't mean that we're sitting on our hands and not evaluating things and just going, well, it is what it is. You just have to, kind of have to live with it. No, that's the whole point of planning and actually putting together a income strategy and a withdrawal strategy and that sort of thing, because then that's really where your focus should be versus necessarily what the markets are going to perform over the next 12 months.
Yeah. And all kidding aside, that list that you had, Stephen, can sound different.
Extensive.
Yeah. Well, and you get different answers from different people because there's lots of things that sound really cool, like, structured products where you have protected downside, or private real estate where you don't have to worry about volatility, or non-listed BDCs, or commodities that do well during hyperinflation. There's lots of things that generate headlines and get attention and make other people a lot of money, but just don't seem worth it based on all the digging and research I've done. I try and keep an open mind and leave no stone unturned and give everything a fair shake, but none of the above has checked the box for me, and therefore I don't think is worth pursuing for our clients. So there's lots of things that sound really cool and that other people might try and include on that list that you had for us and for our clients, but none of that stuff that checks the box for me.
Can you talk a little bit about kind of a portfolio makeup, like a 60-40 portfolio? Is that still valid? I mean, in our day and age, and that seems, it's kind of like you're trying to thread the needle of how much in stocks, how much in bonds, and 60-40 is just kind of what it shakes out to, of just a little bit more on the stock side. But like, is that still applicable in today's day and age?
I think it's still a very good starting point for any conversation around a long-term asset allocation, because the equity markets provide the long-term return and bonds generally provide stability and income, especially if you're buying high-quality bonds like treasuries, which we do. But there's lots of attention recently and lots of headlines, especially from people that manage alternative assets and try and sell alternative asset products that say, 60-40 is dead. You need to add XYZ, and I just disagree because I think the market, especially diversified as we do, U.S., international, with REITs included for real estate, which are a better inflation hedge in my opinion than commodities because the long-term performance is much better. Mm-hmm. I think the 60-40, the way we do it, is still really strong and still makes a lot of sense, at least as a starting point. For younger people with more time horizon, we probably do less bonds because they can take more risk and let compounding happen over a longer period of time, and there's less sequence of return risk. For somebody older that is maybe in a tighter cash flow situation, we might be more conservative. But I think the people that say 60-40 is dead or some variation of that are missing the mark.
Yeah. And just as a caveat, that doesn't mean we put every single client in a 60-40 portfolio. That's just a base case scenario of hey, you need to own stocks in order for your money to keep pace with inflation or beat inflation and to grow. And then obviously for the clientele that we work with in retirement, you need some money in bonds, some secure money, so that if the markets do poorly, we can take from there versus selling stocks in downturns. So that's kind of the whole purpose of at least a 60-40 starting point, but every single situation is obviously completely different, and we tailor it to that to those specific clients. But yeah, very very interesting. The owning U.S. international stocks, globally diversified, and bonds. It seems to be tired and boring and that sort of thing. But hey, as we always say, if there was a better way, like, let's do that.
Totally.
But it's hard to find something better. Yeah. We're searching.
We're still looking, and we keep an open mind, but we have not yet found anything better than a diversified stock portfolio with bonds for stability and liquidity.
Yeah. Okay. So I guess as we wrap up here, Matt, we don't have a price target for 2026. I'm a little disappointed that we're not giving an exact number out there. But what do we think is in store for the future? Positive, negative? I mean, future meaning the next 30 years. Next 20, 30 years.
There's a great phrase I picked up from my first hedge fund boss that I had in Dallas, and he said, "Trees grow." And I think that phrase applies to long-term investing, which is over time, economies grow, people get more productive, ideally population grows, and the combination of those things drives economic growth, which over time drives corporate earnings growth. And there's lots of fears out there, as there always have been for hundreds of years. There was a civil war, there was World War I and II, there was a great financial crisis. There's always been things that were scary and had people worried about the future. And there's things today. Is AI going to take a bunch of jobs? Is geopolitics going to go downhill and cause other issues? And there's a myriad of concerns that would cause people to question it. But my personal view, and I know you agree with this, Stephen, as well, is for the next 10, 20, 30, 40 years, which is how we think about investing our money and our clients' money, I think the economy will grow here and globally, and I think the market will track that. And I don't think we need to keep it. I don't think we need to make it any more complicated than that.
Yep, absolutely. All right, there you have it, folks. Your 2026 market anti-outlook, maybe, Matt?
I like it. I like it.
All right, cool. All right, we'll see you next time, Matt. Thanks a bunch.
Yep, see ya.